Okay, so in this video, I want to give you what I believe is one of the best sort of introduction strategies for order flow trading. It's a strategy based on absorption, and we use delta and price to spot these levels of absorption. What is absorption? Absorption is when prices, let's say we're in an uptrend, price reverses, it might come up again to the same area, but the buyers are not able to push price up higher than this level, right? Let me just put in. So basically that means there were something going up up in this area that made price reverse back down. How do we spot that? These are great ways of spotting support and resistance and getting on the right side of a stronger move. But the question is always how can we spot this, right? Because it's always easy to see in hindsight, but how do we spot it when it's actually taking place? And I do see now, even though this is a coincidence, but we do see a bit of what I want to show you today in this video of how we spot this. So basically, down here I have, and I'll go into a bit more detail later on in the video explaining what this really is, but this is an indicator called cumulative delta. It's just basically showing buying pressure, or like sell and buying pressure from something we call aggressive market participants, and I'll go into detail and explain what exactly that means. But the idea of the strategy is that we see way more buyers, right? And that also matches price action. So many times you're gonna see cumulative delta basically moving in the same waves as price action is moving. But then we can see some interesting things when they don't align. And in this example, for example, we have a level being formed here. Price comes back over to the same level over here. But at this time, there's way more buying pressure, right? So the participants in the market that are moving the market, those what we call the aggressive buyers, they're really trying to push through this level. They don't manage, meaning there is what we call a passive seller sitting up here absorbing all the buying liquidity, which ultimately results in price having to reverse further lower down. Right, and how long these retracements are going to be, is it the complete reversal? We never know that. I'll explain how I use this strategy, but there's many ways that you can use the concepts of this information to fit into your own personal trading style. So that's the basic concept of it, right? We see continued buying pressure. Price action tells us something different. It doesn't look like there's continued buying pressure, meaning there must be a seller sitting here and forcing price to go further down. So to understand what is, let me think how I best can explain this. In market structure, we have basically two types of participants. We have passive participants and we have active participants, or also called aggressive and passive. Aggressive are the participants that are just hitting the buy when they want to buy. They want to get in at the best price, right where price is at now, right? So if I hit buy here, I fill one contract at the best price, where at the moment that I hit the buy button. I'm gonna take that off again. If I place a limit order, that's a passive sell order, and a limit order is a sell limit order is always going to be above current market price, and a buy limit order is always going to be below current market price.
Order canceled. Order canceled.
We of course also have stop orders. A buy stop order is going to be above price, so basically you're getting in at a worse price than where price is at now. Like there's more of a discount down here than there is up here, and you can use that for like a breakout type of style. A sell stop order is always going to be below the current price, so again at a worse entry price than where the price is trading at right now.
Order canceled.
The reason why I'm saying like notifying about limit orders and stop orders is limit orders are active. So this is what you see over here in the depth of market, or the DOM. This is just another visual representation of the DOM. So that basically means when I put a limit order right here, the entire market can see that I have my limit order placed right there. Right? So here we can see there is a larger size of limit sellers, and we see how they move around also constantly, right? So then they're dynamic. We can't really use them as an indication of saying, there's a big seller sitting right here. Let's also place a sell order there, right? Because they're moving constantly, and it's being manipulated quite a lot as well. But basically, when we have these limit orders, everybody can see those on the book, or on the order book, or on the DOM, the depth of market. So in order for price to move in a certain direction, right? Let's say price wants to go up higher. That for that to happen, you need to have aggressive buyers that are buying up the orders that are sitting on the order book, the sell orders, the sell limit orders that are sitting on the order book, right? So the limit orders are not really moving price per se. They're more making, they're providing liquidity for the aggressive buyers and the aggressive sellers. And the reason why that's important to understand is most of the time you'll see market makers and large funds and institutions, when they enter into a position, they're not aggressive buyers and sellers. They are placing their limit orders at a certain price. This is the price I want to get in at.
Order placed.
And then they just have their limit order sitting at that price until price comes up, fills them, and then they're in their position. They rarely buy into a position just at market, right? So we know that the big players, the big market participants, the participants that not necessarily makes the market move, but what makes the market stop moving in a certain direction, they're using these limit orders.
Order canceled.
And it would be really easy if we could just see, okay, here's a big limit seller. If he stays there, I want to get behind that. I want to put my limit sell there, because then price is probably going to reverse down. But of course,
order canceled.
Institutions and market makers, they don't want you to see their where their positions are hiding. So what they will typically do is, if let's say we have a market maker, he wants to fill down here at this price level, he wants to fill 1,000 contracts, right? He's not going to put 1,000 contracts in the order book. He's maybe going to put 25 or 50 contracts in the order book. When the aggressive sellers are selling into that limit order, that the limit buy order that they have sitting down here, once the first, let's say he has 50 contracts on the book, when the first 49 are filled, he's going to stack up another 50. So now the aggressive sellers have to sell another 50 contracts in order to break through this level. Once they maybe sell another 49 contracts, he's going to put another 50 on the book. And they just keep on doing that. It's kind of like what's called an iceberg order. You don't see it happening. You don't see it on the actual book, but you can see them refilling the order constantly. And this goes very fast. Obviously, this is all automated, high frequency trading. It's very difficult to see this just with your eye and being able to be fast enough to get into to when it's happening. Now we see another example right here, actually, as it's playing out. We have similar lows, at least compared to the selling pressure that came down here, right? So there's a huge selling pressure, but price didn't really move that much further down compared to this swing. So that tells me, okay, price is probably going to reverse back up. At least it's going to be difficult for the sellers to get through this level now. Of course, it definitely might happen, and now we also see it kind of happening to the opposite side. I should also say we're in low liquidity time right now, so it's not the best time to demonstrate this. Let's get back to that later. Let's try to stay on course. So basically, when a large institution is coming into the market, they will keep restacking orders into a specific price point, and that is often what causes the reversal to take place, right? So the question is, how do we see when that's happening? Because we already established we can't see it on the order book because they keep on changing that. They add to their positions, they take positions away. Like, how do we actually spot when this is taking place? And for that, we use the cumulative delta. And I want to show a few examples, and then you can go and play around with it and, get a feeling of how it looks like on the chart. Here is a great example that played out right in front of us with this further very strong push down, but price action is telling us, well, price is not moving down to the same extent as what we would expect. There is what you call a divergence, right, between these swing points. So this place right here, which is actually all the way up here, compared to this price. So a lot of aggressive sellers, not of a lot of selling price action, right? And this you can't see when you're only looking at the candlesticks. This is the 5 seconds chart, so also a lot of noise and whatnot. But I like to trade these on the lower time frames. You can trade on any time frame, but obviously it is an intraday strategy. So you would need like 1 minute or 2 minute, I would say maximum of 5 minutes, not more than that. But again, if we just look at this example, right? So the aggressive sellers, they kept on selling, but price didn't break through. Why did that happen? That happened because there were some kind of buyer sitting here, kept on putting passive limit buy orders on the book, preventing the strong aggressive sellers from breaking through this level. And what many times and has to happen is that the sellers give up. They run out of liquidity, they run out of steam, or they maybe just realize, okay, there is a level here, we cannot break through it. I'm just gonna get out of the trade, and then price reverses. And also, of course, when you have sellers who are actively selling into the market and they might say, okay, this is not working out, I'm gonna get out of my position. What are they doing? They're adding a buy order to the market, which adds selling, further buying pressure coming out of this level, right? So if we go back, so right now we're sort of in the middle of London session. There's not a whole lot of liquidity compared to the New York session, at least. This is on the NQ, so NASDAQ futures. Again, I should also say, so let's just scroll back here to yesterday's New York session. That's what you're gonna see here in this blacked out area. So that's basically the first hour of the New York session. I should say to get order flow information, you need a platform that displays or gives you order flow information. Not every platform will do that. I'm using a platform called Atas. I can highly recommend it. I used it for a long time. I'll put a link down in the description if you're interested in checking it out. They give free demos and you can play around with it. But you can also use Sierra Chart. It's very good as well. It's very old school, the interface, very difficult to get started with. But once you're good introduced to it, it's a great platform. Quant Tower is another pretty good platform in my opinion. If you use NinjaTrader, you need to get, I believe, and buy an add-on to get like an order flow package or something like that to get this information. But again, many platforms will give you order flow information. I just use Atas because it's the one I find the most reliable. It has many great features. Maybe I should just quickly explain for those that don't know what delta really is. Like what is the calculation behind this move, these lines that you see down here. So if you just pull up another indicator here, I have to zoom out to really see the values. So here we have the individual delta values, right? So this top line, you can ignore this line and this line. So each of these vertical bars is the delta value for that candlestick, right? So when I zoom all the way in Atas, I see more order flow information. So that's why this candlestick will start looking like, I don't know, was it this one? I just have some volume information within the candlestick. So each of these, I know they look a little bit different than what you're maybe used to with normal candlesticks, but each of these is 1 5-second bar, right? And below here, we then see the delta reading. So in this bar, for example, we saw a negative 201. So that means there were 201 more contracts being aggressively sold compared to the aggressive buyers. So that means there might have been 251 aggressive sellers, but there were only 50 aggressive buyers. So the difference between the aggressive sellers and the aggressive buyers is what you see in the delta reading, right? So sometimes, and of course the opposite, like if you have a positive reading, let's say we have this one, we had a positive reading of 18, that means there were 18 more aggressive buyers than there were aggressive sellers in this candlestick. So if there were no passive buyers in the market, every time that we saw a negative reading on the delta, we would also see a bearish bar. But that doesn't always happen. Like for example, right here, we actually did have a positive delta of 18, but this bar is red. I don't know if you can see that if we zoom in, but this little line on the left side, that's the open and that's the close, that's the wick high and that's the wick low, right? So it opened up here, closed down here. So even if we had 18 more aggressive buyers compared to aggressive sellers, the bar still ended up being red. So that's a divergence within that single bar, and that can already signal to you there's probably some passive seller sitting up in this area, because even with increased buying pressure, we already start seeing that price is not really being pushed further up. And so again, like if we didn't have the passive buyers and sellers in the market would just follow the delta, because the delta shows how many hits the ask to get into a buy position, how many sellers are hitting the bid to get into a sell position, right? But that's not how it really plays out. So the cumulative delta basically takes each of these values and adds them to each other. So we have a negative reading of minus 201, then we have 76 added to the close of that one, so that adds another 76, right? 76 is about a third of 200, a little bit more, and that's also why you see that if you break this bar here up into 3 equals, this one fills up the basically 1/3 of the movement of this one. Then we have plus 13. That means that to the close of this bar, we add another 13. Then we minus 16, and then just means that the cumulative delta then goes down. So basically the cumulative delta is just adding and subtracting the value depending on if it's a negative or a positive reading to the past close of the delta, of the cumulative delta. And that gives us then this price movement. I guess I can take this one away now. So we start seeing seeing the cumulative delta starts looking like price action, right? It starts looking like the candlesticks, but it's not the price action. It's the difference between aggressive buyers and aggressive sellers. So if we go through this trading session, I already mapped out a couple of entries here. So again, what we're looking at, like I showed you in the beginning of the video, where we saw it playing out in real time, what we're looking for is a divergence between the oscillator or the cumulative delta indicator and price. And it's a bit of an art to see these playing out. It's not like you can't say the pattern looks exactly like this. It depends on the flow of the market. And the more you start looking into it, the more you'll start recognizing when it's happening. I should also say, obviously, when you're in the 5 seconds chart, you can't expect huge take profits. On the 5-second chart, I typically aim for like 20 to 30 ticks. 20 ticks is $100 on the NQ, so that's more money than enough, especially if you take 5, 10, 15 trades in a day, which you definitely will get when you're trading on the 5-second chart. You'll get enough setups within the first hour of the New York Open. So in the first example here, we just see, this is the open. There's buying pressure, aggressive buying, and price action shows, yes, that's true. The aggressive buyers are managing to push price up higher. But then we see something interesting happening here. We see a sharp decline, 2 fairly big red bars, and the second red bar is actually white or like green on the delta, right? And on the wick, they tried to push it all the way up to the top, to the same value as where the selling pressure started from. But on price, we see something completely different, right? This bar closes all the way down here. This one closes up in the middle range of this sort of little top cluster right here. That could be a great indication that price is probably gonna fall from here. Not a very clean setup, but again, like I would be more than happy to take this, especially then when we see a little retracement back up into the midway of let's see. So this is basically what we're looking at, right? So these bars here. Right, so this is what we're looking at. We see the price coming up, reversing back down. The delta, the aggressive buyers are trying to push up. They're failing. And then we get that little move back up halfway into the range. That's a really good place to go short from. So maybe from here you could take another 30 ticks just below this little wick down here. 30 ticks would be down here. That's $150, right? This is a bit more clear and a bit more of the classic style. So what we see is price comes back down. Obviously, we don't see all of this at this time. Price bounces off the same level. We still don't really get any clear indication. But then what we see is the sellers are really stepping in. They're pushing down, pushing down, pushing down. But price is not reflecting that, right? So somebody is sitting here and restacking limit buy orders, passive buy orders to absorb all the selling pressure that's being put on the market. The sellers are not able to push through. I would typically enter on this or this bar, so probably this one. The moment that I see this low break on the delta, but price is not breaking lower, right? So I would probably enter here or somewhere in this area. I'll put the stop way like somewhere pretty close below this wick, because I know like if this area, if the sellers actually do win the struggle, then probably price is just gonna dump lower. That means that this buyer, passive buyer that was sitting here, he takes off his orders, he gives up, or he filled enough orders for this price level. Maybe he's also interested in a level lower down, and he filled all his contracts, and then finally the sellers are winning, right? So I put my stop loss close to somewhere close behind this wick, and then I'm always only looking for the nearest resistance, right? In this case, of course, we could have gotten a lot more profit out of that one. You might consider leaving a runner or having a larger risk to reward. I just like these sort of one-to-one. I'm in and out in a few seconds or a minute or so. So I'd have put my take profit right at these top wicks right here. So that was another 30 ticks, so another $150. Then we start seeing delta and price is pretty much agreeing, so there's nothing really to look at here. Then again, we see the same thing happening as we saw before. We see massive selling pressure, not a whole lot of selling price action. So again, here we could take this one up. Don't be greedy. Somewhere in the middle of the range, especially when you're trading reversals. I mean, sometimes you do get the great reversals, the reversal of the day, and you can just ride it and make great profits. I just like these small scalps in and out. When I see this pressure building up, I know there has to be some kind of response to it. It doesn't need to be a big response, but some kind of response needs to take place. So again, sort of up in the mid of this range, 25 ticks. I'm more than happy with that. That's $125. Now we start seeing the opposite happening, right? So here we start seeing more buying pressure from aggressive buyers, but that doesn't reflect on the price action. So the moment that this delta up here closes above this high that's on this candle right here, I would take that short and only back down to, like, not even down to the low, which you can also say, yeah, you wouldn't have gotten away with it. But typically with these short scalps, you just want to be in the middle of the range. You don't want to try and aim for a continuation to the downside or anything like that. That's at least my strategy. You can use it however you want. The concept I want to share with you here is really just the basic order flow concept behind this kind of strategy, and it works great. And also I think when you understand why it works, it for me, at least as a trader, I need to understand why is the market moving. It's not moving because an RSI or a MACD or because of a double top or whatever it is. Those might show what price is doing, but ultimately what really makes the market move is the dynamic behavior between aggressive buyers, aggressive sellers, and passive buyers and passive sellers. And you see that with great detail using the cumulative delta. There are other ways to use cluster charts, footprint charts, that is just way more advanced. And I think that's the reason why I make this video. This is a great sort of introduction for people that are traders that are new to order flow trading. Again, we see here just a continuation of the same, right? The buyers, they think the bottom was in here. They try to push it up higher, but they're never getting above this this swing right here. So that could be another sell just down here to the mid range, the middle of this range, right? So that's like another 30 ticks. And again, it just repeats over and over again, right? So we see buyers are moving price up, they come back down to previous delta levels, or like meaning we had the same amount of selling pressure from here to here as we had buying pressure from here to here in terms of how many aggressive buyers were buying this up compared to how many aggressive sellers were selling this down. But price action is not reflecting that. We're way above the low here. So again, the moment this breaks, I would just take that long. I'll probably take it to the bottom of this wick. Not much higher to that. I might have gotten out of the break even if I saw prices actually reversing. If I didn't get filled here, that's only 23 ticks. I don't know. Let's just put it in there for another 30 ticks. Again, we see the same thing happening here. This might have stopped me out. So I would enter right here. We see the buying, the delta breaking out a little bit early in this case, like around here. So I would enter short here. I might put my stop loss here at about 30 ticks. So up here is 30 ticks. I mean, depending, sometimes I would put it a little bit further. So I might have been stopped out on the first one. So let's just put this one red. But then I would enter again as I see the same thing playing out, right? The buying pressure is continuing, at least at latest when we get over here. I see continued buying pressure. Let's just take this one away. So continued buying pressure, but no reflection in that in price action. So I would take this one here and come back into the middle of the range for 25 ticks. Then next time we start seeing it, here it's just really, you know, delta is reflecting how price is moving. So that's no strong passive sellers in the market at this moment. Then, however, we start seeing this very aggressive move from the aggressive buyers, but price action is not reflecting that at all. So again, just sell this back into the range. 20 ticks, more than enough. My stop loss would not have been more than 26 in this one either. So again, a good 1-to-1. And we see the same thing happening again right here. They're not able to get above, even though they're really trying. Okay, the passive seller is still there. We take that one back into the range, another 26 ticks. And again here, same thing, right? We have basically equal highs on the delta, but lower low on the price. So again, the buyers really tried, but at this time, the passive seller has already moved down his limit order down here, meaning the passive limit is getting even more desperate to get filled. And that's also sometimes you'll see the passive buyers and passive sellers don't always just have static places, especially with iceberg orders. They move the limit orders down as price is going in a certain direction, but that's a topic for another video. But again, here we see equal highs, lower high, definitely take a sell off of that, come back down into these wicks, 25 ticks with limited drawdown. Again here, same thing, right? Delta, like aggressive buyers are trying, they're not managing, they're not able to, they have to give up, back into the range, 22 ticks. Here again, another one of these where we see a prices dying off pretty fast, and we get this last push up, that's this bar, but look how low this bar is compared to the delta reading. Right, so we could definitely take that down to at least these wicks down here, so that's another 20 ticks. Same thing over here, they try to push it up, they're not managing. I'll do another 20 ticks right there. So you see all these small like $100, $100, $100, it really adds up. Obviously, in hindsight, anything works better, right? The art of this is practicing it long enough so that you get skilled at hitting the buy and sell fast enough to get in before the move had actually happened. When you see my live trades and you see how fast I'm trading also, most of the time I'll enter with limit orders just because that's what I prefer. I'm trading mostly volume. I'm also looking at the delta, but with one of my own indicators, and I am looking at these absorptions. And when you see me entering into a position with a market order, it's because I see this type of absorption taking place. But obviously it goes very fast in real markets, and many times you at least in the beginning you see it after it actually happened. I'll maybe advise to start on the 1 minute or the 2 minute chart and then get slow. You maybe get 1 or 2 trades per trading session, but just practice, and with time you start noticing even when they start. And also I would say that seeing it in live real time, you get an additional value that you can't see from just looking at past data that we're doing right now, because you start getting a feel for, man, the aggressive buyers are really active, they're really trying, they're just not managing. Every time price comes up into a certain level, you see it just wick down really fast over and over again. You know there's a passive seller sitting up there, and it's just a matter of time. If let's say that he wants to fill 200 contracts up in this area, right? That means that the aggressive buyers, unless that they push up more than with 200 contracts, at some point they have to give up. And the moment they give up, this happens, right? So it's like, and then that doesn't mean that when they come up into that area again, that he's still sitting here. He might say, okay, I got what I wanted. I got my 200 contracts filled. Next time the aggressive buyers are trying again, they manage to squeeze through it. And many times you will also see like a squeeze bar like this, when they then finally push through a level that has been protected, you'll get that fast wick. That's why I always put my stop loss orders at a fairly close price compared to where I enter. So again, we see the same thing happening here. They really try a huge delta, but actually a red bar. So I would enter right off of there. I would probably just aim somewhere in the middle of this whole range right here, maybe just below these ticks. I might just take 15 ticks on this trade. As price action is slowing a little bit down, I would have my stop loss order up here, maybe above this wick. That's only 17 ticks. So again, 15 tick trade on that one in the positive. I'm more than happy with that. Again, we see sort of the same as we saw in the beginning. Delta is showing that they're still trying, but they're not able to, right? So this close is much lower than this one. So that typically means we can take another sell down there. Then we see here another sort of double top. They're really trying, not managing. We can definitely take that one down back into this range here. And then again here we see the same thing. That doesn't seem to get us out. So that would be on this bar when they push up in the same level here, but we're way behind it. I'd probably put my stop somewhere up around here, so 20 ticks. Yeah, 20 ticks. I mean, we will get out over here. I would probably have exited that one because typically I'd like to see sort of like an immediate reaction when I take these trades. Yeah, I think that's it for the day. Maybe, I mean, I mapped out a few other ones down here. We see the same price action is going down. The aggressive buyers are trying, they're not managing, and then we see this rapid flush. Same thing here. They come up trying again. They don't manage to get up like even to anywhere close to this swing high that where the selling started from. So again, we can just take that one down for like 20, 30 ticks. So on this day, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20 setups on the 5-second chart. Most of them hitting take profit at about, let's say on average, let's say 120, between 30 and 20 ticks. So great scalping strategy. 1 hour of trading in the New York Open. Let's just go. I think I mapped up also the prior to that. So that's over here. I'll just go through it really quick because I think you get the idea of it, and the only way to really start seeing this is if you open your own charts and start looking at it yourself. The first one here is also a little bit atypical, but typically what I see here is just like selling pressure here. So right on this bar is almost the same as where this swing started from, but if you compare that to the price, it's way above, right? And we also, you can say that we have this sort of let's say like just like a break and retest of this level. So expecting price to go up from there. Let's say like we have these wicks, so we get up through, we're right in this break and retest area, and we see the sellers are really trying, but they're not managing. So why not enter for another little leg up there? That's 30 ticks. Again, we see the same thing happening over here. Now price is not really moving down, but delta is moving down heavily. So on this bar where we break the previous low, right? So this is the swing low that was formed here. We break this low on this bar right here. I would enter back up into the range. And that's another 27, 36. Then we see the same thing sort of as what happened over here. We have equal lows, but a much higher bar forming here. So again, we take that, and again, don't be greedy with these. 36 is more than enough. Don't try to aim for the high, just as we did over here also, we're not aiming at the very high. Then over here we see this formation. So that's this bar right here. The buyers keep on trying, but they're not able to, so we can expect a short reversal off of that level. So that's 36. Again, here they're really trying, they're really pushing up, but this area is being defended. This might have been a loss. I might have aimed for a little bit more lower down, like 36. So my stop loss would be somewhere above this high over here, like 20 ticks. So let's just make that red. Then we see, however, on this strong move, they broke through, and the continuation traders are thinking, okay, price is now going to move out, so they continue buying it aggressively. But we see the opposite happening on price. So that means there's a passive seller sitting here absorbing all the buying activity. What can we expect? We can expect price to fall a little bit from that. Yeah, and then it really just continues like that, right? We have the exact same thing. Price is coming up on this bar, breaking the previous high in the delta. That's this bar. They're way below, 50% lower. Take it down. Don't aim for the very low of it. Just, you know, get in and out, take your profits and run, basically. Again, same thing from this high. We see another break of it here. They're still way below, so another one, take it down to these lows down here. Happening again. They keep on trying. Price is way lower. Take it down to these wicks, 26 ticks. Here, this would have probably been a loss. We see a very strong push from aggressive buyers, but they're not getting above. I don't know. I mean, I might have gotten out of that one. Let's just say we take it a loss. I would probably aim for this resistance here. They almost get into it, but not quite. And then they finally push through. So we will take another 20, 30 ticks loss on that one. Then here we start seeing it happening again. Sellers are in control. The aggressive sellers are having a great time. Anytime they push the sell, the market keeps going lower down, but then suddenly they meet some kind of resistance here. They come up, they try again. They really try, but they don't manage. So we can take that one up for a quick buy. Again, here at this point, they're trying desperately again. I don't know if you can see it here on the oscillator, but they're pushing below in terms of how many aggressive sellers were active in this move compared to the up move. But price is stalling way before they even close to the bottom. So we could take that one up again for another 30 ticks or so. Here again, same thing, right? I think you start seeing it now. Here another one. A lot of buying activity, but pretty much equal highs. If I wouldn't take this one, I would definitely take the second one, right? So we see continuation in the buying pressure, but now price is starting to climb down. Can take that one for a sell and the same thing again here. Lot of selling pressure from aggressive sellers. Price is kind of stalling out. I don't know exactly where. I would probably have gotten in somewhere here, put my stop below this wick, 30 ticks, aim for these highs, 20 ticks, more than enough. Here again, same thing. Price is going up, or delta is going up, price is stalling. Just get in behind that passive seller sitting up there. Here again, double bottom on price, way lower reading on the delta. So can take that one for another 30 ticks. So yeah, that's basically the concept behind this strategy. I really do believe it's a great strategy for traders that are new to order flow trading to start finding the edge in getting the information that most traders really don't look at, and that is the information that shows the behavior between passive buyers, passive sellers, and aggressive buyers and aggressive sellers. And that is really that you don't need a big edge to be profitable in trading. And I believe that order flow trading with delta and volume and other aspects of order flow trading really gives you that edge that you just can't get from normal candlestick price action trading. So again, if you get any value out of this, please leave a thumbs up. I'll highly appreciate it. If you have any questions, just get back to me right in the comment sections below. I'll try to answer as fast as I can. I might need to make a follow-up video on this one. I'm not exactly sure, but I can imagine that there will be some questions, and maybe I go over things a little bit too fast. Typically with things that you are used to yourself, you skip through it very fast as it's logical, but many times it's really not if it's the first time you're hearing it. But I think I did explain the main sort of concepts behind the strategy, why it's working, why it shows you where there is an edge, how to get behind the big passive buyers and sellers and capitalize on that. So anyway, that's all for now. Wish you all the best. Take care. Leave a comment, give a thumbs up, support the channel. I'll much appreciate it. Okay, bye-bye.